Now to the main part of this basics of trading. I'll break it down into two parts. So first of all is talk a bit about trading goals, and later how to set up a trade, right? So first of all, there's a difference between trading and investing, right? And trading and investing, main difference here, as you see from this definition, is the time frame, right? So for people who are investing, they tend to dig into company fundamentals. They want to know if a company is doing well and if it's profitable, and they will invest in the company probably for a relatively longer term compared to trading. Trading, people just want to go and make a quick buck in a way, to put it bluntly. So it's more of short-term buying and selling. So what you want to make is the spread. So you want to buy low, sell high, or buy high, sell higher, right? Or some people will do the other way around, sell high, buy lower, and or sell low, buy even lower. So these are the different tactics of trading. And so the main difference between trading and investing will be in the methods and the time horizon. Okay. So what does a trading goal look like, right? Uh, I once attended some webinar like this when I was much younger as a student, and uh, one of the things that we learned at time, which I would like to pass on today, is that we definitely trade for profit, right? If we are not trading for profit, then why are we trading for? But of course, there are some people who would say that I would like to trade for the thrill of it, but mainly we are trading for profit, right? But other than trading for profit, we need to know a bit about ourselves. So in this case, a trading goal involves a bit about risk tolerance, how much risk you are willing to take as a trader. Okay, certain return objectives, how much money you are out to make, what kind of profit you are looking at, and also time frame. Like I mentioned, time frame of trading tends to be shorter than investing, but time frame itself can be further broken down, as we can see later. So an example of a trading goal that we can tell ourselves is that I'm a high risk taker, right, who might want to make $500 off a trade, right, while scalping in the time frame, and I'm prepared to lose about $200 on the trade. So that's my risk tolerance. I'm willing to risk $200 to make $500. Okay, so that's how it looks like. Now we'll go into the individual part. So risk tolerance, trading is a business, so it definitely carries risk, right? Every time we buy something, there is a risk of us not being able to sell it. That's the first one. And then there's a risk of selling it at a lower price, right? It's not a sure win situation where we definitely get to sell it at a higher price. So in that case, trading comes with risk. And not only this kind of risk, but we are talking about economic conditions, like you might be entering a trade at a time when certain GDP numbers might be coming out and they might be above or below expectations, right? Market sentiment, you might be trading in an environment where the sentiment is very positive, where every day there's a lot of activity in the market, or you might be trading in a situation where people are not as optimistic, right? So market sentiment. Of course, company specific issues. There are situations where people enter a trade, and before they can exit the trade, company may say that I call for a trading halt and for an announcement to be made. So company might have certain things. Some companies halt trading themselves. Some companies, there's something happen and the exchange halts trading. So different kinds of risk in this case. Of course, time spent on your trade. Some people get very agitated in when they get themselves to certain trades. So they spend a lot of time on it, spend a lot of mental power on it. So it depends on how much you want to spend on that. And of course, the opportunity cost. If I not trading stock A, if I trade stock B, I might be better off. Something like that. Okay. Next, when we talk about return objectives, when we are taking risks, we definitely want a reward. So the expectation for us is that the more risk we take, the greater the return we get, right? So the amount of return is proportional to the risk. So if you are trading, let's say a stock that can swing by a bit versus a stock that can swing wildly, you expect to be able to make more money from a stock that is swinging wildly rather than something that is not swinging so much, right? So that's why the higher risk, higher return. So there's a proportionate thing there. Sometimes people ask me, is there low risk but high return? In this case, that can't be expected. So the expectation is for the higher risk and higher return. Okay, so return in terms of definitely in terms of profit, and there's always a risk of a loss. Therefore, when we have a return objective, we must think of the possible loss as well. So like the example we had in the first slide of this section is that I'm willing to risk $200 to make $500, something like that, right? So next, we talked about the time frame, and we talked about this word called scalping. So scalping, when people do scalping, they are in it for one tick or two ticks, kind of very small gain. So what we mean by one ticks or two ticks. So for example, on SGX, stocks that are trading above $1 tick by 1 cent at a time. Okay, so 101, 102, 103. So when I'm going for one tick or two ticks means that I'm buying at, let's say, $1.01, 101, and I'm getting out at 102, or I'm getting out at 103. So this is what we call scalping, right? So people who are scalping, you don't need tend not to think very far because these things can happen in a matter of minutes, right? Then there's day trading. People who trade within a day itself, they say I don't want to take overnight risk because something might happen in America overnight, and the next day something bad might happen to the stock price. So I don't trade overnight. I would like to trade within the day itself. I buy in the morning and I get out in the afternoon or in the evening, something like that, before the market closes. Then there are what we call swing traders that tend to see a short-term trend, that they think that, hey, these few days market might be good. I might want to take a trade, might buy something, hold it for a few days, and hopefully I make some money out of it. Right? That's a swing trade. Then there can be a certain longer kind of time frame that we call a position trade that takes advantages of a longer trend. For example, when we had the virus situation in March, some people thought the market was falling, and they took an idea that if I were to buy something and hold it for the next few months, can I make money? Okay, so that's the kind of different time frames that people use while trading. Okay, so have that in mind.